Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss key aspects to constructing a retirement portfolio. Specifically, I'm going to chat about 2 core considerations when building a retirement portfolio, the importance of considering where you place your investments when considering a tax lens, a conversation I have with all of our successful retirees, the importance of a portfolio that can weather market uncertainty, a sample portfolio, and lastly, as always, a few action items for you to consider. So today I'm going to discuss portfolio construction for a retiree. In this episode, we will discuss 2 core aspects to building your retirement portfolio: asset location and asset allocation. These are crucial to consider when building an enduring retirement portfolio that can absorb the ups and downs of uncertainty while giving you the best opportunity for long-term growth and capital appreciation. Lastly, I'll walk you through a sample retirement portfolio we build across our client accounts and how it aligns with other aspects of our fundamental retirement plan, specifically when it comes to tax and income planning. So to start, let's take a moment and discuss asset location and asset allocation. Asset location speaks towards where certain assets are held across different retirement accounts. So, for example, what account should you hold your equity investments in, like stocks, all equities, or ETFs? And where should you hold your more conservative investments like bonds, high interest savings, and other fixed income investments? Furthermore, when we look at these different kinds of investments, how should they be located within your overall retirement portfolio to ensure optimal tax planning over time, especially during your decumulation stage of the registered accounts like RRSPs and RRIFs? Many advisors will apply a blanket approach to retirement accounts, like holding stocks across all accounts, TFSAs, RRSPs, non-registered accounts, or the quote-unquote balance fund across all the accounts without any consideration to how this will impact the retiree, from both a tax lens and an income lens. This is why I believe strongly retirees should work with someone who understands the nuances of deregistering accounts, optimizing government benefits, minimizing tax, and creating a retirement paycheck with your hard-earned retirement nest egg. So back to asset location. Let me give you a very simple example to help articulate this. Say you have $200,000 to invest, and you have 2 investment accounts, a RRIF and a non-registered account. You also only have 2 investment choices, an all-equity investment and a 100% bond investment. Take a moment and think where you would locate the equity investment and the bond investment. Assuming in this very simple example, you can only choose one account for each investment, either the RRIF or the non-registered account. Okay, so now that I gave you a moment to think about it, what account would you hold the equity in and what account would you hold the bond portfolio in? The RRIF or the non-registered account? The answer is a matter of tax. In this very, very oversimplified example, it would make more sense to hold the bond portfolio in the RRIF as any investment held inside of the RRIF is 100% taxable as income. Interest income generated from a bond portfolio or fixed income investment is also 100% taxable as income, while the equity investment should be held in the non-registered account, as these investments are generally taxed on either dividend income or capital gains, which are tax preferred in a non-registered account. Now, admittedly, this is a very simplified example, and rarely do client scenarios align exactly with this all or nothing approach. But what I'm trying to get across here is no two retirement portfolios are the same, especially when you consider tax. You could hold the exact same investments as your neighbor, but if they're located in improper accounts, your after-tax rates of return can be drastically different. So why does this matter? Well, I don't know about you, but I prefer not paying more than my fair share of tax. Another example of asset location would be the optimization of your long-term accounts like the TFSA. This is a conversation I have daily with clients. Here's how the conversation usually goes. Mr. and Mrs. Retiree, it was great going through your fundamental retirement plan and building a long-term strategy to ensure you will never outlive your money. Through our income and deregistration planning, we have determined that between your non-registered accounts, RRSPs, RRIFs, and other pensions, we can conservatively assume you will never need to access your TFSA account for income purposes. With that in mind, knowing that your timeline to use the TFSA is nearly indefinite, it may make sense to assume more equity concentration to benefit from long-term capital appreciation tax-free. We will continue to monitor your plan year over year, and if things change, we can pivot. But based on our comprehensive planning and asset location suggestions, this option will have a notable impact on the long-term capital appreciation of your retirement nest egg. In short, many of our clients who have abundantly saved for retirement find themselves in the situation where the TFSA will not be required for monthly income needs. With that in mind and an income plan in place, locating more equity in the TFSA may make sense. If you want to know more about the impact of this kind of asset location modification, be sure to listen to episode 54, the $3 million TFSA retirement strategy. Okay, with asset location out of the way, let's switch gears and discuss asset allocation. Most of you likely know what asset allocation is, but let me give you some high-level basics and discuss how this dovetails into retirement income planning. In its simplest terms, asset allocation is how you divide your money between different types of investments, like stocks, bonds, and cash, to match your goals and comfort level with risk. Generally speaking, the more stock or equity investments you have in your portfolio, the more ups and downs you will experience in the short to mid-term, with the end game being a stronger long-term rate of return by accepting this additional risk. While on the flip side, the more fixed income you have in your portfolio, the less ups and downs you will likely experience in the short and mid-term, which will likely also translate into a lower return over the long term. Again, this analogy is very general, as many conservative fixed income investors experienced a shock in 2022 when interest rates spiked and the traditional fixed income investment they had got rocked in the short term. But I digress. So what does this have to do with building an enduring retirement portfolio? Well, first and foremost, we need to understand your willingness and ability to accept the ups and downs in your portfolio. It's also crucial to understand how you've reacted during times in the past when there was market uncertainty. Did you modify your investments during uncertainty, or did you stay in your seat? We use this information to help determine your required rate of return to achieve your retirement goals and legacy goals. This will give us clarity on your ability to accept investment risk and also give us clarity on what needs to be achieved from a return standpoint to convert your goals into reality. With that in mind, we want to be sure that we are also considering the inevitability of a market volatility and how that will impact how we pay your retirement paycheck. I always say to my retirees, it's not a matter of if markets will go down, but when. And when they go down, we have a defined action plan for what will take place. This speaks to the importance of having an asset allocation strategy that is able to absorb 2 to 3 years of market uncertainty, giving you the confidence that you won't run out of money while ensuring the preservation of your long-term retirement growth objectives. So, with asset location and asset allocation in mind, let's discuss a high-level sample portfolio that will help to check a few boxes when it comes to creating an optimized retirement portfolio. So let's take an example of a couple, age 60, with $1.5 million in investments, $600,000 in RRSPs, $300,000 in TFSAs, and the balance, $600,000, in a joint non-registered account. Through our FRP process, we've determined that they require $75,000 a year in income from their investments, which a required rate of return of 3.5% is needed in order for their funds to last to age 95. We have determined they will delay OAS and CPP to 65 and draw down their RRSP accounts tax efficiently during the tax valley before age 65. At age 65, we will adjust their income withdrawals downward as their income from their retirement portfolio will be offset by government pensions. We have also determined that based on some reasonable income and return assumptions, the possibility of them accessing their TFSAs for income needs is very low, and at its earliest, they may access the TFSA in approximately 20 years. With that scenario in mind, we consider a higher equity component within their TFSAs. We develop a bond ladder and equity strategy in the registered accounts that aligns with our year-end tax planning and deregistration strategies during the tax valley. And we also create a tax-wise investment solution within their non-registered account to accommodate income needs while being mindful of asset location. That was a mouthful, I know. So, to put it all into English, we create a tax-smart deregistration plan to ensure your retirement income can weather inevitable market uncertainty while keeping CRA out of your pocket. We have spent decades advising and building strategies for retirees to ensure we thoughtfully build retirement portfolios with asset allocation and asset location in mind, among many other considerations. Okay, so that will do it for today. I hope you were able to take a piece or two of information from today and begin to apply it to your own retirement plan. Here are your action items for today. First off, crack open an investment statement and do a bit of research to determine where your assets are located. Is your TFSA underutilized? Do you have tax inefficient investments within your non-registered accounts? While you have that portfolio statement open, consider where you would draw your retirement income if equity markets decreased for an extended period of time. Do you have other investment options you can pivot to avoid selling your equities in a down market? Lastly, retirement portfolio construction is incredibly nuanced, and I would argue it's the most crucial time of a person's investing life that they want to get right. If you have an advisor, be sure that all the pieces of the puzzle are being considered in an overall strategy. And if you're a DIY investor, roll up your sleeves and keep doing your research, or reach out to a group like ours to help you do the heavy lifting. Okay, so that'll do it for today's episode. Make sure you add us on all of our socials, LinkedIn and Facebook. Be sure to subscribe to the podcast and leave us a 5-star review. Be sure that you're signed up for our weekly Retiring Canada newsletter. And hey, When it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.